Hello everybody. In our video today, I'm going to take you through investment property analysis, where I will show you what you need to be looking for if you are trying to figure out if an investment property is actually going to make you any money or not. Now, there is so much to cover in this that I'm actually going to break it down into two videos. And so in this one, our first video, I'm going to discuss the key factors that make up an investment property that you need to know about, all of the variables you need to consider. And then in our second video, I'm going to go through exactly how to plug in certain assumptions and how to crunch the numbers and actually do the math on a range of different types of investment properties so that you can go ahead and invest shrewdly to build yourself an incredible investment property portfolio. So let's go ahead now and jump into this. And what I'm going to do first is explain the 5 profit centers in real estate investing. Now, there used to just be 4, but since the pandemic, I now think there's 5. And so if you've seen me speak on this before, stay tuned because you might learn something new here at the very end. But these 5 profit centers will be a part of almost every single residential investment property that you go ahead and buy. And what you want to do as a real estate investor is understand how you're prioritizing each of these factors in the investments that you're choosing, because it's a little bit different for each investor in each market with each strategy, depending on your goals and your approach. But if you're really keen on being a great investor, then you're going to want to get all 5 of these working for you. And I'm going to tell you what to look for as we go through this. So in addition to understanding these factors, it's also important to remember that this is not passive real estate investing. We're not like buying stocks or financial instruments and putting somebody else in control of this. When you're investing in real estate and owning property yourself, you are in control. You're in the driver's seat, it's your hand on the wheel. And so your ability and your energy and your tenacity and your drive is going to come out in terms of the results that you're going to get from your real estate investing. And so if you don't want to be actively involved and if you don't have a lot of energy for this, give your money to somebody else and become a passive investor. But in the next 2 videos, we're going to talk about doing this yourself and taking action to build your wealth. So the other thing I want you to know is garbage in, garbage out. So we're going to be talking about all of the variables in the equation that you need to be considering when evaluating an investment property. And if you're not diligent with respect to the input of these variables, if you're not getting down and dirty and trying to evaluate exactly what to put into your economic model, you're not going to get reliable information coming out of it. Okay, so it's the same with any financial model: garbage in, garbage out. So be as accurate as you can with your inputs. So the first thing that we're going to talk about for these 5 profit centers is passive appreciation. Okay, so this is what everyone has kind of come to think of when it comes to real estate investing. Is you want to buy property where it's going to go up in value, and that of course is a huge component to successful real estate investing. And so this is a graph from the Canadian Real Estate Association that basically shows the average price of real estate in Canada going back to 2005 here. But you know what, like the same way that you could talk about average prices in Canada is kind of like talking about the average weather in Canada. It's really hard to paint the entire real estate investment landscape with the same brush. And we're going to talk a little bit about how to drill down and get very specific into your local market with this. So in addition to passive investing, how you structure your investments will be paramount, because if you put a low down payment down, so you're not putting a lot of your own money in, you can get a huge return if the property goes up in value because of the function of leverage, where if you're buying an investment property, you can put $1 down and effectively turn it into 5. So you can do with a 20% down payment, 100 grand is getting you a $500,000 asset. So using leverage is really important depending on whether or not you're in a wealth generation mode or a wealth preservation mode. We also want to talk about macro and micro markets. So macro market, like we talked about the Canadian real estate landscape, well, this would be like the Toronto or the Vancouver or the Calgary or the Edmonton real estate landscape. But you can't go and just buy a property in Toronto. You're actually going to buy a community or property in a community in Toronto. And so the micro markets are the communities inside the macro markets that you need to know about, because when we're looking to optimize passive appreciation, we want to be investing in what I call a corridor of growth, or an area where other people like governments or private enterprise are going to be spending money to improve your location for you. And that's a key factor when choosing what investment property to buy, is the location of it, so that you can get the most opportunity for solid passive appreciation. The next one I want to talk about is principal paydown. So principal paydown is how fast you are paying off the debt for your property, or how fast your tenants are paying off the debt in your property for you. And so what we're looking at here is just a simplified graph here from Wikipedia that shows how much of your mortgage payment will go to paying off the loan versus how much goes to paying off the interest that you're paying to borrow that money from the bank. And you can see here on a 30-year mortgage term, it's a very kind of nice smooth curve. Your payments will stay consistent all the way through, but as you progress over time, you will pay off more and more principal and less interest with each individual payment. And so how you structure your investing, you may choose to have a lower amortization, which means you are paying off your mortgage faster, but that will mean a greater mortgage payment, which will result in less cash flow. So there's a trade-off here that you need to understand, and how you go about making these choices with your investment property is completely dependent on what is best for your wealth building strategy. But if you don't know, how mortgages work and anything about principal paydown or amortization schedules, you need to know that because you can adjust these things just like you would adjust, the temperature in your house or something like that. You can play around with some of these variables to have the ideal outcome for your wealth building strategy. In addition to that, we've got net cash flow. So we've talked about appreciation and principal paydown. Well, net cash flow is basically like the amount of money that is left over after you've got all of your rental income and you've factored in all of your expenses. And so we'll spend a lot of time on this on the second video in terms of looking at each of the individual costs that we're going to have, and how to know if you need to include certain costs or not include certain costs, and what variables to pick so we don't have garbage in, garbage out when we're doing this. But there's a lot of cost centers associated with real estate that a number of investors don't pick. And some investors will actually be too conservative and they'll allocate too high a cost to some things that, in my practical experience, just haven't really shown up that often, as long as you're managing your property properly. So we're going to look at how to evaluate cash flow. But you need to know that cash flow is, of course, a function of how much you're paying for a property, how much you're putting down, the interest rate on your mortgage, how much rental income you can get. Are you going to be renovating your property and putting more capital into your investment to get a higher rental income? All of those things are factors that you need to be considering before you buy something. You can't just go in and purchase a property because you like the area and the location. You really do have to have a strategy for it. And if you have a good strategy, then you can achieve great cash flow. And this is the hardest part to get when you're investing in real estate, is this net cash flow. But if you do it right, think about it. You could be buying a property, you're renting it out for a certain amount of money, you've got all of your costs and everything factored in, and then you have money left over at the end of the month, in addition to paying off your principal, getting passive appreciation happening, and then the other profit centers we'll talk about here. That's the dream, is to find a good property like that and hopefully buy a whole bunch of them so that you can eventually have the lifestyle that you want to when you decide that you're done with your real estate investing. So that's net cash flow. And what used to be the last one, I should say, is active value add. Okay, and so active value add is where we put our own stamp on an investment property. This is where, we would be changing the use, we'd be doing something to the property with our own creative energy and our own capital and our own strategy to take something that might not be economic now and then turn it into an incredible investment property for us to own for a long period of time. And we're actively taking action on something and adding value to it. And this goes back to what I was saying at the very beginning, where your own passions and talents and energy for the business is going to come out. So if a dollar is 100 pennies to you and you absolutely love real estate investing, then you should be picking properties that have a good opportunity for active value add so that you can get a return on your time and your energy and your talent. If you're not into all of that, then buy something that's brand new, that's turnkey and ready to go, and don't stress about this, right? And so how you decide what type of property to buy is highly dependent on your approach and how you plan to make the most of all of these profit centers. Now, talking about value add, we're not speaking about flipping houses here today, but when you're adding value to a property, that is a strategy for some people, is to own real estate for a short period of time and make money out of it while they're doing it. That's harder and harder to do now in Canada with how high the prices have got and all of the holding costs and inflation on costs for labor and materials. Harder to do that. Taxation is making it more difficult to do it too. But that is sort of the purest form of active value add, is flipping houses. And you can see here, this is a deal from years ago for another video that I did on the Redline Real Estate Group channel. But it's from 2019. You can see here, this deal was bought in April of 2019 for $298,000 and sold 4 months later in August of 2019 for over $100,000 more. And so you can see here, even just from the exterior photos, they did a little bit of work to this place. But that's not the only way that you can add value. Changing land use, so applying to the city for a higher zoning where developers could maybe acquire your land, is a great way to actively add value. Adding an income suite to not only add a way to get more income out of a property, but you're making it more valuable for somebody that might buy it from you to, say, live in one unit and rent out the other. Modernizing a home is a great way to do that, just fixing it up and making it look better. We talked about land assembly, so we talked about change of use, but land assembly, where you can put several different lots together into a parcel to sell to a bigger fish in the real estate investing game to go and develop something, is another great way to add value to a property. Or even just stuff like changing the floor plan, even from the old 1950s style with the galley kitchens. You can open this up to have these beautiful open concept plans, and they're just so much more appealing, not only on the pictures, but they're more usable in terms of how modern families work with open floor plans and everything like that. So lots of different ways that you can add value to property there. Now, the last one on my list, and this is something I've introduced because of my experience with investing during the pandemic, is I used to be just a really strict income suite investor. All of my property basically had an income suite added in, and I was really about net cash flow at the end of the month. But what I noticed during the pandemic and how hard it was to travel to various places, and also with the proliferation of short-term rental developments and just great property managers that have emerged in this particular space of real estate investing, is that you can buy property and not only have it as an investment, but you can use it to enhance your lifestyle. And so this is something that I've taken advantage of personally in the last few years with investment properties out of province, where I can use it. My family can use it as a holiday in addition to renting it out to earn income on a short-term basis. And so if there's a lifestyle benefit there, that means I am not spending money to go and fly someplace else and rent a different property in a different location. I'm just going and using something that I already own. Then there's a lifestyle benefit to that particular piece of real estate. And so this is something that I think can be considered more and more as shrewd investors are looking to not only work hard, they're looking to play hard with some of their investment properties too. So if there's a lifestyle benefit, that's something that you could go ahead and factor in. So after you've gone and educated yourself on all of these factors, you need to know if they all come together or not for your investment property. And so this is a tool that I've been improving over the years that I provide to all of the realtors that work with us at Redline Real Estate Group. And if you're a real estate agent and you're into real estate investing and you want to know more about that, you definitely need to follow us and at Redline so that you can see how we teach real estate agents to skin deals and run numbers for their clients. But I digress. You as a real estate investor need to be able to have a calculator to put all of this together. Now, I'm a spreadsheet guy. I was an engineer before I entered into the real estate game. So Excel works really well and kind of comes naturally to me, but you don't need that. And you can buy these investment analyzer tools from all sorts of different vendors that make stuff like this now. So I made my own that works for me, but you don't have to use this one. But you do have to have something that will bring in all of the factors over the time frame that you want to be investing in. So factoring in appreciation, a way to factor in active value add, work in a mortgage, a Canadian mortgage, by the way, where interest is compounded semi-annually, not in advance. It's different than American mortgages, so make sure you get a Canadian mortgage calculator if you're doing that. And then in addition to that, being able to plug in the active value add that you're doing so that you can see all of the different ways that your investment property could come together for you. So if you have all of that together, then you're ready to start, or you know how to do that, then you're ready to actually skin investment property deals and look at an actual piece of real estate and do that. So that's what we're going to do in our second part of this series. We're going to look at a couple different properties, a condo, a townhouse, a single family home, and we'll run the numbers on them together. And you can see how you can go about putting in the assumptions into the model so that you don't have garbage in, garbage out, and you can have a high degree of confidence that what you are putting into your model will be what you receive after you buy something. So if you found the first part of this valuable, definitely watch the second video for this. And if you're finding the channel to be informative, it would be awesome for me if you could give me a like and subscribe to the video. If you're looking for an awesome investment property realtor somewhere in Canada, you can definitely reach out to me at my website here. I'd be happy to get you connected. Thanks very much for watching, guys, and we'll see you in part 2.